And welcome to the Life Settlements Podcast with your host, Rob Haynie and Mrky. Guys, good to see you again. I haven't seen y'all for a while. I hope you had great holidays, and I'm very interested in the topic that you're taking up today.
It's a new year. We're glad to be coming back after our first year of podcasts. I think the first year went great. We had 6 or 7, which our goal when we started these podcasts was, to enlighten consumers, clients, advisors, anybody and everybody about the life settlement process and everything that exists around the life settlement process. A life settlement isn't the end all. Once you buy a life insurance policy, that's never someone's goal is, hey, I can buy life insurance and I can sell it when I'm done with it. No, that shouldn't be your goal. We simply provide an option for those folks. And it's been mentioned before, there's over 500,000 policies that do end up in lapse or surrender for various reasons. I wish all of them worked out for everybody, but they don't. That's why our industry exists. So that's why the podcasts were created. That's why we bring on really anyone who has an interest in telling their side of the story. And Steven, he's got and we'll let him jump into this and Rob can introduce him, but he's got an outstanding background with regards to financial services, how to treat your clients. And he came to us, Steven's not a client of ours. This is really the first time we've engaged with Steven. He came to us from the last podcast that we did, and we had a guest on that explained, in his opinion, how universal life policies had not been designed to last into clients' mortality past their 80s, how they weren't designed to effectively run and build cash surrender values. And Steven had chimed in through a LinkedIn discussion we had, and he felt he had a different view. And that's what we want to bring on. We want to bring on different views. Again, life settlement shouldn't be your destination when you take out life insurance. It's an option. So Steven, thanks for joining us today. Rob, I'll have you introduce Steven and his background,
Sure.
And we'll get to talking.
Yeah, I was part of that discussion on LinkedIn, and I instantly liked Steven because he was giving a different opinion, which we live in America and you're still allowed to have different opinions. So Steven works at KB Financial, which is an ultra high net worth advisory firm, which is located in Princeton, New Jersey. Just as an aside, our business started, literally the life settlement business, that is, in the ultra high net worth arena. That was our audience. We were dealing with individuals like Steven who had clients who had life insurance that wasn't working out as well as they intended and didn't want it anymore, and we were able to sell it. Steven has done, like I said earlier before we got on the podcast, that if I told you everything Steven did, this would be the entirety of the podcast. But let's just say he uses independent research, some of which is patented, to help clients achieve better outcomes related to financial service products. He presented last year at the ABA Trust and Estates Group, ACTEC, NAEPC, and 30 other organizations, and that wanted to unwrap the black box that is life insurance. So with that, Steven Zeiger, I'll give you a few minutes to say anything that I left out, and then we'll get right into it when you're ready.
Sure. Well, first of all, thanks for having me on today. I think it's interesting that I was sort of debating Elon through the podcast, through LinkedIn. And, but you guys are, all about trying to help people. So even though we were debating, we're able to have a great conversation here that will actually lead to more settlements. So even though that's not the area that I specialize in, the area that I specialize in, leads to more settlements than really the model that Elon was talking about. So let me go a little further into that. So Elon believes that universal life, variable life, and index life will all lapse, and whole life won't lapse. And that's really singing from the sales manual. And what I speak about is not from the sales manual, but what does the Uniform Prudent Investor Act say about life insurance? What does FINRA say about life insurance? What does the OCC say about life insurance? What do adjudicated lawsuits say about life insurance? And if you follow that guidance, it never states whole life's better, universal life's better, variable life's better. It talks about monitoring an insurance company so that if their claims ratings fall, you might want to go elsewhere. The regulations and the adjudicated lawsuits and the various acts talk about looking at costs, right? The lower cost product is going to, not premium wise, internal cost wise, that's going to be a better settlement than a high cost product. So the product type really isn't what we're going to speak about today. We're going to speak about how do you evaluate costs inside of a life insurance product? Because if I was to ask Rob or Mark or Bill, when you make an investment decision, do you choose the investment that has the highest costs or the lowest costs?
Lowest.
So Morningstar, we all know it's an independent third party. They don't sell investments. They don't sell insurance. And they did a white paper where it was called The Predictive Power of Fees. And it matches exactly what Mark just said. If there's anything in the world you can take to the bank, it's that expense ratios help you make a better decision. In every single time period and data point tested, low cost funds beat high cost funds. Do you think the same thing applies to life insurance?
No. No.
Right.
We know that.
So nowhere in this did they talk about any particular type of fund, and in none of the laws, rules, acts, and regulations related to life insurance did they speak about a particular type of life insurance. They talk about a duty to investigate costs. They talk about a duty to disclose costs, a duty to evaluate costs. And that's what leads to better performance, not the IUL person who says, IUL is the greatest product because it's got this floor and this cap. No, lower costs lead to better performance. And it's not because of a higher dividend that some whole life purveyor, because if the whole life dividend is accompanied by a high cost, the dividend is sort of meaningless. So does that sound like a healthy framework for how to evaluate life insurance? Right? It's product agnostic, right? What are the ratings? Who's got low costs? Who's got low premiums? Who's got high cash values? And who's got the underlying asset, whether it's the general account of the insurance company or whether it's a mutual fund like subaccount, who's got better performers?
Yeah, and what you said, I hope resonates with those that might be listening in, because on the flip side, what we do see, and we've discussed this, is we do see the policies that all of a sudden the clients are sitting down looking at their statement saying, wait a second, my costs have gone up. Now I no longer own the lower costing insurance policy. I took out this universal life policy when I was in my 40s or 50s. And I was quoted on this illustration that $30,000 a year would maintain coverage on this $1 million policy well into my 80s or 90s. Well, now you fast forward to when clients get into their 60s, 70s, and 80s. Now they start to become a life settlement client, if you want to say. Now they're staring at that annual report, or whatever it is, and it says, well, no, sorry, your premiums are no longer 30,000. They're now gone up to 45 or 50 or 60. They've doubled. And that's what brings clients to us. And is that the design flaw on the carrier? I don't know. I'm not an insurance expert. You're going to know a lot more about this than I, Steven. But that's what fuels our industry. And I think that's what got you interested in what Elon was saying, that how so many of these universal life and the derivatives of a UL, IUL, VUL, GUL, or the favorite product of the decade is regarding UL. We see these policies that just aren't performing. The costs have gone up. And now the client says, wow, what just happened? And do I have another option? And that's where maybe smarter advisors come into play that can manage their policies for them or put them into better performing, lower costing policies. Can we control the carriers? What did we, 16, 18 different carriers over last year, the year before, that had cost of insurance increases? Can we control that? No one can. But is there a better plan around it? Steven?
So now let's talk about these bar charts and line graphs that you're seeing on the screen, because this is what really leads to better decisions and better outcomes. I'll walk you through everything, but just so you know, just like we have Morningstar that provides independent research on life insurance, and we know them as a place that provides independent research on investments. There's also a company called Veralytic, and Veralytic owns a couple of patents on life insurance research. There's a company called Ebix, they just changed their name to Zinnia. They also provide independent research for life insurance. And there's a company called The Ethical Edge, which maybe we'll get to. And what they do is they run Monte Carlo simulations for life insurance. But let's talk about these costs for a moment. So here we have this is an actual case from about 15 years ago. It's the first one I ever did regarding using independent research for life insurance. And just so you know the background, I walked into an attorney's office and the attorney said, I have a client, he has $14 million of insurance. He wants to buy a total of $50 million. He goes, but I really don't need your help. And I said, how come? He said, well, I've got somebody from MetLife, from Guardian, Mass Mutual, Northwest Mutual, Packle. I got 12 insurance brokers bidding on the case, as Mark laughs, right? And I said, well, that's probably why you need my help. He's like, what do you mean? I said, well, is each agent telling you that they've got the best offer on the table? Is each insurance company saying that their product is best? And he said, yeah, they are. I said, well, in my model, I'll take all those agents' work. I'm going to ship it off to these 4 independent third parties, and they're going to opine on what's best, not the salesperson, independent third parties. And that's actually based on an adjudicated lawsuit. Maybe we'll talk about it, called Cochran versus KeyBank. But let's look at the research. So this little blue bar here says that MetLife is charging 17 cents for each dollar of death benefit on a present value basis for their internal costs. And this is the patented benchmark of what every insurance company in the country that offers a general account product is what they charge. And on this, it's not, you can see there's a 7 cent per dollar difference between these two bar charts. And if you multiply 7 cents, you can barely see it, times $12 million. You know exactly how much this person is saving in internal costs. 7 cents per dollar times $12 million. Now this is the premium for the policy in green, $260,000 a year in green. And this is the patented benchmark of what everyone else charges, $360,000 a year. So this policy is looking pretty good. We know MetLife has great ratings. I'm not going to go through that. The costs are low. The premiums are low. Let's look at the cash value. If you pay $260,000 a year in green to MetLife, your cash value will grow from $1 million at the time of review to $16 million in the future. And if you give the same $260,000 a year in premium to everyone else, you run out of cash in 35 years. You might still have a death benefit. You might not still have a death benefit, but you'll have no cash. Now, the reason why I'll have no cash is because the other insurance companies' costs are higher. So now at this point, I was presenting to the attorney and his client, and they said, hey, Steven, other people are telling us we should get rid of this policy. You're sort of the outlier saying that this one's good. And I said, well, I'm not saying it's good. Independent third parties are saying it's good. I could convince you to replace this policy with a BS product that'll never, ever, ever work, and I'd make $500,000. But I said, let's take a look at your next policy, and you'll see how the research works. So this is the same insured. We can really quickly see that New York Life is charging 32 cents per dollar of death benefit, twice as much as MetLife. So what did this person do? They said, Steven, I want to buy $50 million of coverage in total. How do I do that? And I said, well, do you agree that we should get rid of this policy because you're being charged twice as much as you are compared to the MetLife policy? He said, yes. I said, okay. I go into the Veralytic research and I can see at your age and your health class which insurance companies have the best ratings, which ones have the lowest costs, which ones have the highest cash values, which ones have the best underlying return on cash value. And he said, okay, great, let's move ahead. So what that individual couldn't do in over a year of meetings with 12 other advisors, he was able to do in 40 minutes. And just to add more to the story, so here's Elon saying whole life, whole life, whole life. You can clearly see this whole life policy it's an underperformer. And not only that, it's an underperformer that you guys can't settle. However, this person moved to settleable policies. So he has a better outcome because he's no longer wasting cost and he's no longer wasting premium. And if later in his life he decides he doesn't need these policies, we call up Rob and Mark and he can sell the policy for millions. Now, does that seem like the story that you're used to from financial services of look at costs, look at performance, right? So
I'll start off with wow. It'll be the first thing I'll say. And this was how many years ago did you present this case, you said?
Approximately 15.
And you've been utilizing this exact protocol ever since?
I do it on every case.
Every case. So I was just going to say before I let you go is I think you might be a good person to call if anyone's out there listening, looking for a person to help them, guide them through the process of buying life insurance and probably more impressively understand what it is they're buying and all the moving parts. I think you might want to give Steven a call. So with that, Steven, I'll let you take the floor again.
So now I want to talk about the investment business prior to Morningstar. So if we rewind the clock 20 years, you'll notice that the life insurance business was a bigger industry than the investment business. And then what happened was ERISA was passed, employee rights, and Morningstar was invented. And that led to consumers saying, wow, now I've got some transparency here. And they ended up starting investing more and more money. So what's going to happen in the life insurance industry when this model of independent research takes off? More people will buy more insurance and more people will settle their policies later in their lives because they decide, hey, my needs changed. Rob, can you get rid of this for me? And can you get me more money than the insurance company is offering me cash surrender value wise?
Yeah, and and I wrote down some notes here. Hopefully I can bring them all together. And that's why our industry exists. Rob, you just touched on something that's important for anyone that may be listening into our podcast today. We've got two audiences in a way. We've got one audience that already owns their life insurance. They've owned it for 2 years, 10 years, 20 years, 30 years. And again, as we've discussed previously, they're staring down at their annual report. They're staring down at a statement that says, wow, cost did go up because I'm paying more for my insurance. What didn't go up was my cash surrender value because the cost from the insurance carrier went up, affecting my cash surrender value. And thus the performance did not come out as the consumer, as the owner of the policy had hoped for, or maybe at onset of the policy's delivery, the illustration that was run incorrectly. I mean, years ago, they used to be run at Steven, 12, 14%. That doesn't exist. We all know that. Life insurance policies, no investments perform on a linear fashion year in and year out. You have ups and downs. And if you have a down with life insurance, that greatly affects your policy performance. So that's the side we see on a daily basis in the life settlement industry, is all those policies that didn't perform. If I'm someone listening in here, I'm in my 40s, 50s, or 60s, and I'm thinking about taking out a large life insurance policy before I do it, I would absolutely look into bringing someone like Steven in so you can do an independent review. Especially the larger your policy, the larger your premiums are. So you better get that policy right. Whether it's a whole life policy, which our industry does not buy a lot of, we really don't. Whole life policies are expensive. You can't manage the premiums as well as you can with a UL or a diversion. And whole life policies do tend to perform, at least from what my knowledge is, a certain level, 4%, 5%, and build significant cash surrender values. Well, that's the number of life settlement has to beat is that high cash surrender value. So if I'm someone thinking about buying insurance at a large amount, I would probably reach out to Steven to make sure I have an independent voice comparing all the types of insurance and what's going to best fit my needs. And then once I hit my 80s and 90s, if that need has changed, which again, that's why our industry exists. People always say to me, why would someone want to sell their policy? It's an easy answer. For the same reason they bought it. The exact same reasons why you buy insurance exist for why you sell it. Your needs change. You bought it for your family. Guess what? Your family's now all growing up. Your kids are financial advisors, doctors, lawyers making great money. Hey, mom and dad, we don't need that policy as we once did. Look into another option. That's our optional life settlement. You showed something on the initial screen that I don't think a lot of people pay attention to, is these policies that were written many years ago. And Steven, chime in and I'll shut up here in a second. They were written to a client's mid-80s because that's when mortality took place in the mid-80s. 10, 20 years ago, people thought, hey, if you live to your mid-80s, that's it, you're done. It's not the case. Mortality has greatly adjusted over the last 10 years, 20 years. When we thought, 20 years ago, someone will only live to their mid-80s, if you're healthy in your 70s and remain healthy in your 80s, standard mortality for a male in the life settlement industry is age 93. For a female, it's 96. Yet these policies weren't designed that way at the onset. They should be going forward right now. Would you agree, Steven?
Yeah, totally. We, often see policies where if the person lives to age 100, the insurance company is going to pay out a benefit on a taxable basis. So we need to help the person fix that. By the way, I'd like to tell you my first settlement story because I think it really plays into what you guys are talking about. So an individual called me. He was in his 50s. He had $2 million of term life insurance, of policy. He was paying $2 million. Let's delete that. He had a policy with a $2 million face amount, and his premium was $2,000 a year. And he said, I want to sell it. I've been diagnosed with stage 4 cancer. And I said to him, just keep that low premium going and your wife's going to get $2 million. I don't want to settle this. I think I'm doing the wrong thing for you. The policy's only, you can afford that. And he said, I want to pay off all my medical bills. I want to go on all those trips that my wife and I have put off before I pass away. And there was no way to do that without selling the policy. So I helped him sell it for hundreds of thousands of dollars. And later, after he took the trips and he paid off, they found a cure for his disease. He's still alive, but he didn't know he was going to be alive.
Sure.
And he'd send me pictures of he and his wife traveling around the world, having that last trip that meant the world to him, right? And he could not have done it if he cashed in the policy for $19, right? So it's a great story what you guys do.
Yeah, and I see those stories, hear them, and have to, unfortunately, take part of them. And they're hard because people can sell their policies if they're in their 50s or 60s and they have these drastically shortened life expectancies, which is what's known as a viatical settlement. If you sell your policy and have a life expectancy under 24 months, it's coined a viatical settlement. And the good news is IRS gets to touch none of that settlement proceeds. But you do get clients. And that's my first question when a client comes to me and says, listen, I am only 60 years old, but I have this life-threatening illness I've been given 18 months, 24 months. And my question is, why do you want to sell it? Hold on to it. And the answer, like you just said in your client case, they wanted to use the proceeds for a better life over what they thought was their life expectancy. And that is a portion of our industry, the viatical settlement scenario. Rob may have the numbers on this. I'm guessing it's less than 5% of the sales in the life settlement industry. Again, viatical, you're dealing with life expectancies 2 years and under. Life settlements, you're dealing 2 years to somewhere around 22 years at a maximum. But we do see those scenarios, and you do get very sizable offers for those types of policies. If you have a 2-year life expectancy on $1 million policy, you're supposed to be paying, I think in your case, you said $2,000. You're going to get an offer 60, 70% of the value of that policy, or at least you should, which is what, a broker like us, when we get brought in, that's our goal, is to see how much can we drive the price of this up. And if the client wants to sell it and use the money to go off to Hawaii and take a family vacation for the next 2 years, that's not our decision. But it is a tough decision. I have a case last year, and beginning of last year, got the client all his money. And we kind of had this bond. Sounds weird, but 6 months later, I'd followed up with his contact. And unfortunately, the gentleman had passed away, but he did exactly what he wanted. Took the money and he, had fun with it or whatever he wanted to do. I didn't dig that deep, but yeah, that's a side of our industry that we do see. And it's unfortunate, but we do exist for that side. So yeah.
And the only thing I would add is all those stories, and we've had hundreds and thousands of examples of what happens, but there's sometimes the other unique feature about a life settlement. Sometimes you're talking to a client and he or she may think this sounds too good to be true. And sometimes we go out and we get them an offer that honestly exceeds their expectations and quite honestly exceeds our expectations. And the client doesn't sell because they've made that policy absolutely real to them. And now they see it as something more valuable. So something that the initial conversation started with, I want to get rid of it. Now they want to keep it. Now, many times they come back and see us 6 months, a year, 2 years later. But the great thing about that and what you bring, Steven, with your products and services is the understanding of what the actual value is. What is your policy worth? What is that life insurance policy you're considering buying going to cost you? And not me telling you, but a third party, a very, very well-respected third party. And I think information in the financial services business and trust is the two most valuable things you can get. And that's what we try and provide. And it certainly seems like that's what you try to provide in your practice.
Yeah, and I'll add something. I'll let you, Steven, follow up. And I've said this before. I say it every time. If you want to make the most informed decision of why you should sell your policy or not, again, the most comprehensive view of why it makes sense to sell your policy or not, look into a life settlement. Why do I say that? Because part of what we do is we do collect clients' medical records. No, they don't have to go to the doctor. We simply collect their medical records to formulate a mortality, a life expectancy. And that's done by several different parties, several different underwriters, all come back to us with different life expectancies. And we share that with our clients. So now that client can sit down with his or her advisor, Steven, and Steven could put 3 or 4 things on the table. They can say, okay, well, you were thinking about selling this $1 million policy. Unfortunately, your cash surrender value is only $50,000. That's what we see all the time. Well, you looked into a life settlement. Well, here's the good news. Their offer is $250,000. And we'll dig a little bit deeper. Your mortality, life expectancy. And I know that's a morbid scenario to discuss, but it is important. Now you can sit down with that client and say, okay, cash surrender value, life settlement value. Oh, by the way, it's based on a 10-year life expectancy. Well, let's look what a 10-year life expectancy should pay out in premiums. And let's see if we can manage that better. Can we drop the death benefit, pay lower premiums? Can we simply pay lower premiums through not building cash surrender value, just paying your COI year in and year out? Yes, you can do that. But again, I say it over and over, we offer the most comprehensive view of why it makes sense to sell your policy or perhaps not. And there are scenarios where we deliver everything I just said there, and the client says, well, hold on. Sat with my advisor and we're going to go a different avenue. And that's okay. It doesn't bother us. Yes, it costs us money to do what we just did, but it's okay. It's okay if they can sit down and make that informed decision with their advisor. That's what our industry exists for.
Perfect. So since you like the first tool, I'm going to show you a second tool that I think you and your audience will like. So what we're going to do you guys know what a Monte Carlo simulation is?
Yeah, it's using financial forecasts, right?
Yeah, it's, in a life insurance illustration, the illustrations run at a level 6%, for example. But what happens if we vary that and see if the sequence of returns affects the performance of the policy? So I'll walk you through this pretty quick. Since your audience is becoming, more and more educated on insurance, we can go fast. But here we have a 42-year-old male, their preferred health. They want to buy $10 million of indexed universal life insurance. When the agent is suggesting that they borrow $569,000 a year from a bank for 10 years to fund the policy. And then when they're age 65, they're going to take a $14.6 million policy loan to pay off the $14.6 million bank loan. And then the policy is going to pay the owner $556,000 a year from age 66 to age 100. Right. So that's what we're looking at. And this is a real case from a trust and estate attorney. And here's the illustration. On the left side, here's the $569,000 premium for 10 years. On the right side, there's the death benefit of $10 million at age 42, growing to $17 million 20 years out. The person is investing in the U.S. pace setter point to point and the balanced trend fund point to point. There's a floor of 0. So you can't, other than the expenses incurred in the policy, you can't lose money. And then there is a return here, maybe it's on the of 6.44%. And let's go to the next page and see what's happening. Here is the $14.6 million loan coming out of the policy to pay the bank loan. And then there's $556,000 a year of tax-free income. The death benefit is $18 million, falling to $3.9 million at age 81, when persons should still be alive. And on the next page, we see additional $556,000 of income back to the policy owner, and the death benefit grows from $4 million to $35 million. And on the next page, just so you know, your quiz is coming up in a second, there's no more premium due, and the death benefit grows from $41 million to $314 million. Now, what do you think the odds are that this thing continues to age 100 if we vary the return?
0.
0. Okay. Rob, what's your choice?
Well, I'm going to go the opposite of Mark. I'm going to say they're what do I say? 100%?
Sure.
Okay, let's say 100 just so I can be different.
Because if you're talking, instead of having a straight 6%, as I said, linear performance, if it drops down to 2 and 3 for a few years, it greatly affects the policy.
But also goes above 6.
Right. Okay.
Right. Yeah. And sometimes it'll work. Sometimes it won't. So what we do is we go to a company. I know you guys have LISA, the Life Insurance Settlement Association. We have LISA, Life Insurance Sustainability Analytics. And what they're able to do is run the illustration 1,000 different permutations and combinations. And there's just in green, it shows here's the premium going in. In blue, here's the loan to pay off the bank loan plus the series of tax-free loans to the policy owner. On the next page in green, it shows, hey, here's your cash value. In blue, it shows here's your death benefit. And the difference between the two is the cash value, the amount at risk. And then here we got our final, here's the truth. So if you run at 1,000 different permutations and combinations, this person's life expectancy is to age 88. The first failure occurs, 20 years before life expectancy. Half of the failures occur by age 69. And the probability of this thing reaching age 100 is only 16%. But the agent's saying to the client, hey, this thing runs to age 120. Let's pretend it doesn't perform well. It's going to last to age 105 and you'll be dead anyway. But that's not, this is evidence. This isn't sales spiel. Mm-hmm. Now, the next thing we did, the client, the prospect said, well, what happens? How can I improve this? So I think on the next slide, we took away all those withdrawals other than the first one. It still only succeeded 54% of the time. So you can see these are powerful tools. So this person will end up buying something that works and something that's settleable when, if they no longer need the policy. Now, I'm just saying, I'm required since I'm a securities broker. Let me show you. This is pretty funny. So let's pretend this thing blows up. Let's pretend it's at age 95. There's no more death benefit. The trust owes the insurance company $133 million. Where are they getting that from? And that's why it's so important to use these tools to make sure that you have a better outcome. I'm just going to show my my contact information for 2 minutes, just because, FINRA requirement, play by the rules.
Yeah, and again, we've said this. This is what we see as an industry. And you picked an age. I'm curious. The policy would perform to the client's age 88, I think. Did I read that correctly? On one of those illustrations? Because that's the failure that we see in poorly designed policies. And I spoke about this. Is these policies, UL, that's mainly what I'm talking about. They were designed to last to a client's mid 80s. Well, as I mentioned, clients aren't living to their mid 80s. They're now living to their early 90s and mid to late 90s if you're female. So that's what we continue to see as an industry. And if you're someone just now taking out insurance, and especially a large amount, boy, I would dive deep into that policy and contact someone that's much smarter than I, like Steven. So you can look at the performance of that policy. You can run the Monte Carlo and any other methods to say, all right, will my policy actually last age 95 to 100? Because I don't know when we're going to draw the line. People are, they have to die sooner or later. Are we going to live to our 110, 120? I don't think so. I hope not. I don't think that'll be good for society. But these policies that we've seen, they weren't designed. They weren't designed effectively 10, 20, 30 years ago, because everyone thought you're going to die when you're 85, 83. And now we're seeing that was incorrect. And you better now, if you've got a new policy, you better design it to your mid 90s to age 100, if not beyond. We're seeing a lot of those guaranteed universal life policies hit the market now that do run beyond 100. And guess who loves those? All of our buyers. Why? Because they don't want that client hitting 100, still living, and the carrier was one that said, oh, you live it to 100, death benefit becomes 0. So these guaranteed universal life policies that have been designed that run past 100, those are a sweet spot for the life settlement market right now, because people are living longer.
Exactly. And we're seeing that in the variable markets too, where you can buy a variable policy with a guaranteed premium, a guaranteed death benefit. If the policy performs well, the cash value will push the death benefit up. And then if the person's needs change, they call up Mark or Rob and they say, hey, can you help me sell this for more than the cash value? And if they're if they're impaired or whatever, they can get a better deal in the open marketplace.
Question might be way off the topic. I don't even know if do you feel life insurance is a good investment for clients when properly designed?
Yeah, so I see that more in the PPLI space, where a wealthy individual can choose from the types of investments that they're choosing from outside of their insurance. They can get into hedge fund, private equity, private credit, and invest in those inside of life insurance. And sometimes we see it in the variable space. From what I see, lots of those IULs are going to be, problematic, because even though you have the floor, because of the cap, when the market goes up, the market doesn't go up for you. So the cap sort of kills you.
Kind of like an annuity. I bought an annuity years ago, and I just was looking at it. I'm like, this really didn't work out. How the performance in the stock market over the last 5 years was 20% and annuity had a cap, had the floor, which I got sold on, which now maybe is a good idea. But yeah, the insurance contracts, I see them similarly. And I guess, I'm not an insurance expert. No way. Do I have an insurance license? Yes. Do I sell it? No. I simply help people on the backside when it doesn't perform. But that's why I asked that question to you. Do you feel a life insurance contract is a good investment? And it's different for every individual. I already know that going into it. I've always been a believer that whole life is a decent investment. It runs at a certain return. Mass Mutual, Guardian, some of these great carriers always show a 4 to 5% dividend return or whatever it is. Those seem to do well, which is why our industry doesn't like them. But by and large, all these ULs and the version of the ULs, for some reason, they don't seem to be working out, or at least the ones we see, as well as what was projected 10, 20, 30 years ago. So that's why the question was asked, do you think these insurance contracts are good investments for a client?
Yeah, so I think that in many cases, the agent sort of disappeared. And, I'm not a good sailor. I usually just sit in the back of the boat and let somebody else sail. But the captain always says, if I don't change my course throughout the day, we're going to miss our target by 4 hours. But if I constantly make little 10-foot changes to get back on track, at the end of the day, we're exactly where we're supposed to be. It's the same thing with life insurance and your investments. You have to meet with your advisor once a quarter, once a year, see where you are. If you need to dump in another $500 to get the policy back where it's supposed to be, when you're 47, you won't need to dump in $250,000, when you're 75, right? So it's really about that annual review. So it's not a surprise. You're taking care of things all along the way.
You just did the commercial for us, and we tell advisors, we tell consumers, you should be doing a policy review for your clients, whether they're in their 50s or our marketplace, 65 and above. You should be doing a policy review every year to take a look at the performance of that policy, compare it to your needs, and then come to that decision. Hey, is this thing working out or not? And if the answer is not, do I need my life insurance coverage as much as I once did? Or do I have other policies in place that I can keep and then maybe sell this one that's not performing and use those funds to fund my other insurance policies, which we see a lot. We see clients come to, especially the high net worth, ultra not high net worth. They don't have one policy. They have multiple policies. And they'll bring us their book and go, here's 10 policies I own. Which one should I sell? Well, we can't give them the advice on which to sell, but we can give them every single offer on each one. And then they can sit down with Steven or their advisor and say, look, we did a life settlement review on all 10 of your policies. Here's how each one of them priced. Now you make the decision. Do you want to sell this one to fund these? And that's what we see a lot of these days is clients that are, I won't say overinsured, but just have a lot of insurance policies in force. And then when someone's smart enough to do a policy review, they realize that, wait a second, hey, this one over here didn't quite work out like we thought. Do I have an option? We're that option many times. Now, can we get an offer 100% of the time on a policy? No, there's plenty of instances where we take a look at a policy, take a look at the client, and our offer may not stack up, or we may not get an offer at all for various reasons. The policy's too expensive. The client's going to live longer than what life expectancy buyers want. But again, policy reviews. So you mentioned a few times there. If you're a consumer, an advisor listening in on this, again, one takeaway right now, as Steven just said, you should sit down with your advisor and do an annual policy review, whether it's a term policy, well, that's an easy review. You just want to catch it before the conversion period expires, or any other type of policy, IUL, UL, whole life, whatever it may be. You should be sitting down and talking to your financial advisor. And if he's disappeared, which, let's face it, happens a lot of the time, your insurance agent sold the policy, now he's selling cars or real estate, he's gone. Find yourself a good, trusted financial advisor that can help you with this decision.
Well, let me put a bow on this, because when I talked to Steven earlier, we talked about the review, and Steven makes it abundantly clear that he does recommend them and does perform them. One of the reasons it's important to do a policy review, and also with respect to life settlements, is our market changes all the time. 10 years ago, if you were to tell your client who's 60 that they might be able to sell their term life insurance policy, you would have been wrong. But today you can tell them that. If you would have told your client 10 years ago about a retained death benefit, no one would have known what you were talking about, but today those exist. So keeping in touch with the people that you use for your life settlements also enhance that experience for your client when it comes to the annual policy review, because policies that couldn't be sold are appraised 10 years ago or even 20 years ago can be appraised today, and who knows what will happen 10 years from now. So without further ado, I just want to thank Steven, and Bill's probably going to come on and say a few words, for his time and expertise. And I learned something, that's for sure. And that's always valuable when the host of a podcast can actually learn something from his guest. That's a real treat. So I want to thank you for that, and for your time today, and for always sitting listening to Mark Mrky, who was across the building from me in his Nebraska headquarters. And Bill, I'll leave it to you.
No, this is a really, really interesting episode. I only have one question for you, Steven, and it has to do with this transparency sort of revolution that you referenced early on in the podcast. How long do you think it's going to take to the point where it becomes standard practice for people to experience or expect the kind of transparency that you discussed in terms of evaluating the values and what you're getting in terms of what you're buying?
Yeah, I'd like to tell you that it's going to be quick, but unfortunately, sort of the evidence that we have is, New York State was the first state to implement a client's best interest regulation for life insurance, and agents sued to overturn the regulation. So we are
Wow.
So we are far from it. However, New York State Court of Appeals constitutionally affirmed that regulation, and if you went to a doctor and the doctor said to you, "Hey, Bill, before I take care of you, I just want to let you know, I don't follow the Hippocratic oath of first do no harm. Right? You'd run for the hills.
I would leave right away. Yes.
Right. Well, it should be the same thing in this industry, right? We don't charge for the research that I showed you, the Monte Carlo sims that they do cost $500. But we don't charge for that research, but every person should say to themselves, hey, Mr. Agent, you're advising me, go get one of these reports for me. And if the agent says no, you should find a new agent. Just right, because we want clients' best interest for ourselves, and we want it for our clients. It leads to better life insurance policies, and it leads to policies that are more easy to settle.
Yeah. So just to be clear before we wrap this all up, you as a buyer, as a client, have the right to ask for it. And we know what to do if you don't get a response saying sure.
Yeah, just like if you're a client and you have a right to ask for an illustration on your policy, you absolutely have a right to call up whatever carrier your policy is issued from on a yearly basis. I believe it's once a year. Now, believe it or not, it's tough to get these illustrations at times. We battle with carriers, clients battle with carriers, but you absolutely have as a client's right. If you have an insurance policy you've taken out and you're wondering, is this meeting my needs? You have a right to call that carrier up and say, hey, show me what my minimum level premiums look like till I last age 100. You have the right to do that. And now you can take that illustration. You can go meet with an advisor like Steven and decide, hey, does this policy meet my needs? Or is there another option? As we've said time in and time again, sometimes we are that option. Life settlement isn't the reason why you buy insurance. It should never be the reason why you buy insurance, but it is an option for once you owned your insurance policy and for whatever reason your needs have changed, the policy hasn't worked out. You've sat with your advisor and he said, yeah, you know what? No, this policy hasn't worked out. Let's look at the different options you have and let's make sure we include the life settlement option.
Yeah, that's excellent. And Steven, I know you shared your information on the screen. For those who were listening to the podcast who weren't able to watch it, I just want to assure them that contact information is going to be in the show notes so that if you're listening to this podcast, you can easily go down and check the show notes and learn how to get in contact with Steven if you've got questions. Rob and Mark, folks want to get in touch with you to talk about their scenarios. What's the best way for them to reach out to you?
You can reach me always, Mark Mrky, Mark M at lisettlements.com. Settlements is plural. And as most all people know, you can reach me on my cell phone, whether it's 7 a.m. out here on the East Coast in Florida or 10 o'clock at night. You can reach me at 954-326-9378.
And I'm Rob at lisettlements.com. And to beat Mark, you can reach me at 6 in the morning on my cell phone up till 11 at night, 954-599-4433. Thank you. Good. And I'd give you mine. You could reach me at 5 in the morning, but I'm just not going to go there with it. So for those of you who are listening to this podcast, who are not subscribers, I would recommend that you become a follower, and that's easy. Just reach out and hit the follow button, hit the subscribe button. That way, every time a new episode of this podcast is dropped, you can listen to it and you can learn a little bit more, as I do every time I'm a host on this podcast. It is fascinating. The other thing I would ask you to do is, if you find this information useful, if you find it informative, and you know somebody who might benefit from it and from listening to it, share it with them. Let them know. It's great. Word of mouth promotion is a fundamentally superb tool, and we would very much welcome it. Meantime, until the next time, I'm Bill Tucker. On behalf of Rob and Mark and everybody at Life Settlements, I want to thank you for taking the time to listen today. And I will remind you that you can, as a matter of fact, go out and make today a great day or not. That is your decision. Until next time.
Thank you for listening to Unlocking the Hidden Value of Your Life Insurance, the show that helps you unlock the hidden value of life insurance. Click the follow button to be notified when new episodes become available. Visit our website at www.lisettlements.com or give us a call at our office line at 866-326-5433, extension 1017. You can also directly contact Mark Mrky at 954-326-9378. 954-9378 and Rob Haynie at 954-599-4433.